All right, got a little over 3 minutes to go before we get started. And we've already got Dashio checking into the Twitch chat. How's it going? Prinzmeister, how's it going? There are gonna be a lot of it'll be okays and reassurances on tonight's stream. Don't you worry. Even though I think when we flip up here, futures are minus 0.43%. Not the greatest start to the week already, but like we said, everything's gonna be okay, and we are gonna explain exactly why in just a couple minutes. All right, that is the end of the timer, and we are once again for another week. So once again, thank you to all of you who have been tuning in week after week, even though last week, as we can see right here, was not the best week for us. More for in the Twitch chat. How's it going? Glad to have you guys all on and watching with us on this Sunday night. But yeah, as you can see, the way that we always start this out, we are going to do exactly what we do every single time. Talk about what happened last week before we get into what we've got for the week heading forward. And shout out to Quantier 34 for the follow. Appreciate that. I had to strain my eyes really quickly because the screen that I've got my stream feed up on is super, super small. But taking it from the top, we've talked about UWMC to death. We're going to be holding on to that one. We did get into some 820. I don't think we had these the week before, right? Yeah, so we added these August 20th 7.5 strike puts for 40 cents. And as we know, we could already jump into Thinkorswim right now to take a look at the chart on that one. If we go UWMC, look at that. Futures have already popped back up above the 4,300 level. So already off to a great start on the stream tonight. But as we can see, it's been beat down pretty heavily. RSI, one of those favorite indicators that we have about whether a stock is overbought or oversold, is what we love to look at. It's trading at 770 right now. We sold the 7.5 strike puts. We got 40 cents of premium, meaning that we're going to have a 710 break-even price over the next month on those. So if we zoom the chart in a little bit, 710 break-even price. If we get our drawing tools right here, puts us right here for break-even, which over the next month, right, we're looking at a 6-month chart right here. Only really a few days in the last 6 months has this thing traded below 710, which is our break-even price. So we're perfectly happy to get in one of those things. And we'll talk about this a little bit more later on in the stream as we get going. But, things are looking a little bit shaky in the market. And I always find that when things are a little bit uncertain in the market, the best thing you could do is have your money invested in companies that are, really well operated and have actual cash flows and profits to back up the valuation on their stock. And I think this is one that fits the bill right there. This is one of the biggest mortgage companies out there right now. Have a ton of revenue, and they're setting records quarter after quarter after quarter. Housing market is killing it right now. I mean, that obviously is another area where things could pull back, but for the foreseeable future, this should be okay. And due to the nature of their business, they're not too impacted by refinancing, so they should be good to go in that regard as well. But from a pure numbers perspective, like we mentioned, 750 strike put means 750 is our max profit point. And 710, since we got 40 cents of premium on a 7.5 strike put, is our break-even price, which goes right there. This other red line we see down here is for the other set of 7.5 strike puts that we have expiring in December, which have a much lower break-even price, but at the same time are expiring in about 5 months as opposed to 1 month for this UWMC play, where I think if we pull the calculator up, even if we assume that we sold these fully cash secured, and TD gives us a little bit of margin buying privilege on those, but we'd be getting 40 cents of premium off 710 of capital at risk. And again, we get that 710 of capital at risk from the 7.5 it would take for it to be fully cash secured minus the 0.4 credit that we receive, because we're going to get that no matter what. So the 40 cents of premium that we're getting divided by 7.1 per contract at risk is a 5.6% return if fully cash secured over the next month. And I think that's a really solid value play as we're looking to maybe be a little bit more defensive and find our way back into a stock that we really like the value of and have been in for a little bit of time. So that should cover the addition of that. ICLN, as we mention every week, is the most boring play on the planet. Would not recommend getting in, so we're not even going to talk about that one. PSTH, we talked a little bit about this one as well last week. We've been playing it for a while. The option premium disappeared, and it's one of those things where while we did have a little bit of a loss showing, and we could scroll back up here and find it. Where is it? Where is it? Where is it? Yeah, so this was the trade right here where we got out last week. We'd been in it since February. We were trying to be maybe a little bit stubborn because we thought that there was a chance that it would bounce. And, when we calculate our win rate, we don't like to have the losses locked in there because that kind of messes up our win rate a little bit. But with that said, it's one of those things where we derive a lot of the value that we make in the market from option premium. And if there is an option premium on a stock that we're trying to play, it's probably just not the best idea to continue playing. So we got out for a loss, right? We took a $420 loss just that week on the stock. We wanted to hang around a couple extra days just to see if there would be a little bit of a spike. But as you could see, we got out at 2150. PSTH took an even further dive, so getting out at that 2150 level before it tailed further down towards the end of the week actually saved us a little bit of money. So while we did lose $420, if we held on towards the end of the week, we would have lost another $1,500. So I guess taking a smaller loss than what we would have had getting out of a play is a smart move, and we consider that, kind of a gain in the sense that we saved ourselves $1,500. But then going down another row, our big loser on the week were our Corsair shares, unfortunately, and these things have just been continuing on a downward spiral ever since this initial spike that we tried to take advantage of and get a little bit of a premium. But as is the theme with a lot of our other plays, we've been continuously driving down our break-even price. So we got in initially kind of on the tail end of this spike when implied volatility was elevated, so we were able to get some really good prices on 35 strike puts. However, as you can see from the chart right here, it gave back these gains very, very, very quickly. So we are in the situation where we took assignment of the shares and we're running our HT wheel strategy. If we go over to the tab where this is broken out, for whatever reason I decided to start this on row 2, But as you can see right here, right, we sold these 35 strike puts. These were assigned down to 5 right here. So we got these 1,500 shares from this. We sold covered calls on those initially. Those made us $2,400 back. We rolled those down to 6. Those made us $750 over the life of the play that we had right there. And that was just for our 7/16 expiry. So it does suck objectively that we've lost, what, $3,800 on the shares and $2,800 initially on the cash secured puts that we sold. So overall, the long positions on this play lost us about $6,700. However, we've got shares. Shares never expire. We're going to keep selling calls week after week after week. And even though we've lost $6,800 on the long positions, we're in a position right now where by August 20th, we'll have made $5,100 on the calls that we've sold. And, more importantly here, I can zoom in a little bit so it's a little bit easier to see. Our break-even price is the most important thing we could talk about right here, right? We got in on the play when Corsair was trading at 38.5, and that is right up here on the chart, right? So we got in near the top, but again, that was by design because we were able to sell 35 strike puts for $1.18, so we knew that our initial break-even price, even though we were getting it at 38.50, was going to be 33.82, and that was a number that we were comfortable with in the short term. And now that didn't quite hold up, but that's okay because we've got the shares and it's been selling off pretty consistently, which is a little bit discouraging. But if you read further down our little break-even price tracker that we have built out here, we sold some calls that lowered it even further. Then we sold July covered calls that lowered it down to 31.72. We rolled our calls down for a little bit of a credit to further lower that break-even price. Then we've gotten to the point where we're at today, where our break-even price is at $30.37, thanks to these 32.50 August 20th covered calls that we sold for Corsair. Now, unfortunately, we did want to sell a little bit higher than the 32.50 strike that we sold. If you look at the option chain right here, they've got earnings coming up, I think maybe a week or two before this expiration date. So these have a little bit more volatility than typical, than what you'll typically see on a month-to-month basis. So we would have really liked to have been able to sell some of these 40 strike calls, because if you pull up the chart on these really quickly, these strike calls were selling for a lot more premium, even just a little under a month ago. Rather, you could have gotten a couple bucks, but this slow bleed off has really killed the premiums. We would have, it would have been nice to be able to be a little bit more aggressive and leave ourselves some upside on the shares, to where we could have, potentially dumped them for 40 if the stock shut up, and that would have been a really nice gain. However, that's not the case. The stock is sold off, and the most important thing right now is that if the stock keeps selling off, that we have ourselves protected and lower this as much as we can. And the way that we do that is by selling the closest to the money calls that we can. Because as you can see, as we get closer to the money, that's more and more premium that you collect. And the more premium that you collect on the covered calls, the more you're going to be able to decrease that break-even price. So that's what we did. We sold 32.5 strike calls. We essentially just rolled these forward a month. We got $1.04 of credit on the roll. So that's, we've already made a little bit on those, but as we know, what we've made on a day-to-day basis on these doesn't really matter. What is a lot more relevant is the fact that we're going to get this 15.60 no matter what, but all it means for our shares is the most we could sell them for is 32.5. So if Corsair bounces back to 32.50 or above by August 20th, despite the fact that it would have dropped 15.58% on us in 2 months, which is a huge drop on what normally is a relatively steady stock, we're still going to find ourselves in a position where we pulled a 14% return on capital, and over a 2-month period that annualizes to over 100%. And again, that is one of the best parts about the strategy we're running right here. Corsair, when we entered, could have gone up. We could have hit max profit right off the bat here, and we could have never thought about it again. However, the fact that we are able to be in a long position on a stock that's gone down so significantly against us and still find ourselves with a path to a really nice annualized profit number, that's what we're going for with the strategy, and that is why we love this strategy, and why when we're able to identify opportunities where premium looks like this, we will happily take them. But for now, we're continuing to ride this thing down until we get a bounce. But since we've sold these for August 20th, we're just going to hold on tight, wait until earnings come up, and then we will be able to reevaluate from there. But long story short, sucks that it dropped so much. It's dropped 23.82% on us we started this play on June 14th. So it's literally been just over a month, and there's been, a 25% haircut on the stock price. But, we're still in the game. We're continuing to lower our break-even price, and we can lower our break-even price forever. The stock isn't going to be able to go down forever, right? It's going to bounce at some point. We just don't know when that's going to be. So we're going to stay patient, continue to sell covered calls, and that will get resolved eventually. So while it does suck, obviously, on a week-to-week basis, that this was not one of our biggest losers. It was our biggest loser. If we took Corsair out of the portfolio, we would have been profitable this week. But you know what? That's okay, because we got several other plays that we were in on our SPX hedge since the market dropped last week, as we could see, by 0.96%. That one hit max profit for us. IPOF, unfortunately, had the premium cut in half. This is the one option buying play that we were in on. Nothing as far as what I see on this stock has changed one bit. Timing may have not been the best since we got in at 42 cents. It's down to 22 cents. But again, the downside is limited to 10 on this one. It's pretty much trading at 10 right now after the market pulled back this week. But again, these expire in September. So we've got 2 whole months to wait on this one. I mean, we could wake up tomorrow. There could be some news on it. It could jump up 10% in a day, which is not out of the ordinary for something like a SPAC. And this will be sitting at 1, and all of a sudden we've got a gain overall in the position. So one of those things we're just going to keep in the back of our portfolio, watch it for the next couple months, and then if something happens, we can take some profits. But if not, the remaining loss is something, the remaining $875 loss on this is something we can pretty easily absorb over the next couple months. So not worried about that. ORPH, that expired worthless. AHT, we just had these calls that we sold sitting around because there wasn't really a shot that it would sit back up there. BBIG, that's another good one to talk about because that one was all over the place this week. And we admittedly did not do a very good job, but as is the case with our strategy, we're going to be okay. So let me quickly pop open the trade breakout tab that we had right here for BBIG. You'll know we got in on shares at 379 back on June 30th. We sold 4 strike covered calls for 35 cents, which gave us an initial break-even price of 344. But what happened was it did not stay above 344. If we go to the 5-day chart, I think we'll do a better job illustrating this. So this was Thursday, and unfortunately, at the beginning of the week, it was above 4. We were looking like we were well on our way to make max profit, so we were super excited about that. But over the next 2, 3, 4 days, it shot all the way down and started testing this 310 level. So we said, you know what? Similar to the mindset that we had with Corsair, the fact that, look, if this thing keeps dropping, we could see a decent loss because our break-even is 344. So what we're going to do is be conservative right now and play defense right now. So Thursday morning, unfortunately, at the bottom, is when we rolled forward our calls, and we rolled them down a strike, meaning that the most we could sell these shares for is $3 a piece, as opposed to, being able to sell them for 4 with the 4 strike calls. So the most we could do is sell them for an $1,100 loss. But again, the premium we receive makes up for that. We'd be in an overall profit position, and a profit position where as long as BBIG finishes above 3, we're going to make a 13.582% return on capital in 2 months, which again, over a 100% annualized return despite a huge drop on the stock. So still good value there. We're, losing the upside case of being able to dump these for 4 where we could get a much bigger gain overall, but that's okay. We're not too worried about that because as long as we win every trade, you're never going to go broke taking a profit. This may not be the home run play that we potentially had envisioned off the bat thanks to this big drop, but, that's all right. But what we did do was off the bat, typically with our HT wheel and the sizing strategies that we use when we do something like this, we only go in with about half the capital that we're comfortable with off the bat, and that's what we did. So with the extra capital that we had reserved, and we still have a bit that we were comfortable allocating to this because we only have, I think, a little bit under $4,000 invested in this. But with that, we were able to sell 2.5 strike puts. So what do we know about these 2 new options that we sold, right? We added the 3 strike calls because we rolled them from the July position. Then we added 2.5 strike puts. What we know is that, every single cent we get on a covered call is a direct reduction of our cost basis. So that was going to reduce our break-even price from $3.44 down below $2 a share, down below $3 a share into the high 2s. And then on top of that, since we sold these at a 1-to-1 ratio, meaning we have 1,400 shares and 14 covered calls, we sold 14 cash secured puts as well. This is also going to be a cent for cent reduction to our cost basis. So Thursday morning, we saw ourselves with a 344 cost basis, and we said, okay, this thing's testing 310. We don't want this to get, down into the twos and start getting away from us. So what we did was, we took our medicine, stayed conservative, and between the premium we got on the 3-strike call and the 2.5 strike put, we were able to lower our break-even price by 81 cents, which on a stock that's trading at, 320, 330 a share, that is some incredible value. As you can see, we've been in this play for what? It's July, or it was July pretty much 15th when we updated our position right here. And in 15 days, right, we entered on June 30th when this thing was trading at 379, and within 15 days, we've been able to knock over $1 off of our break-even price, which is a 30.61% reduction, which in plain English means that this stock could drop 30% on us and we're still going to break even overall in the trade. And that is irrespective of anything that happens, after August, right? If this thing keeps dropping and goes to like 270, it's going to stuck. But one, we're still going to be profitable because our break even is 263. And two, we can just do the same thing for the following month, right? Option premium is incredibly elevated on this stock. We've got options at 50-cent intervals, so there's tons of flexibility about what we want to sell. And if we keep holding on to these shares and this thing gets below 3, we could get into a position, right, where for the September calls, we get this thing down near $2 a share. Then for the October, November, December, and so on, we could be dangerously close to having a $0 basis, meaning this would be a risk-free play by the end of the year. So this is something I expect to hold, at least for the next few weeks as we're managing our break-even price. But most likely scenario, I think, is that this finishes above 3, and this is the profit that we would be looking at, $518 off just under 4K in collateral. But still, would be a double-digit percentage drop on us. We would have a 13.582% return on that despite the drop, and a 150% annualized return. So we spend a lot of time right now talking about Corsair, BBIG, and we're going to talk about CLOV and SOL in a second. But we spend time talking about these because these are, quote unquote, our losers. When we look at our trade performance on the year, these are the ones that are kind of stragglers because they're one of the losses that are in the heavy minority in what we're doing, right? We're not even going to bother spending too much time talking about the rest of these green plays that have been closed out because most of the time the stock either stays flat or goes up and we never even have to think about it ever again. But it's important to know what to do when the stock moves against us. But, things like DD, SPCE, CLF, NEGG, we were in and out of those last week pretty easily. So if you're tuning into the stream and thinking, good Lord, like we're in CRSR, we're in BBIG, we're in CLOV, like what went well? We're only spending time talking about those because those are the ones that we had to manage at the end of the week, and those are the ones that we're continuing to hold positions in as we move forward in this upcoming week. So far, right, between the two we've talked about, CRSR, it's a little bit below our break-even price, but then BBIG, we're very comfortably above our break-even price. So really no reason to panic even on some of the losers that we had last week. So if we move forward to the next one that I wanted to talk about, the one that we rolled forward, if we go to that weekly tracker, we had CLOV right here, and that's one of the ones we're taking into next week. Moving over to that breakout tab really quickly to show what we had set up. We initially got in on 716 9-strike puts. We did that when CLOV was trading at 920, thinking, hey, decent potential break-even price just on that leg alone, right? Because if you sell a 9-strike put, your break-even price would be 9 minus 0.36, meaning you've got an 8.64 break-even price for under a week's time. So I thought that was a really nice value proposition. But again, we're only really talking about this one because it was a loser. If we take a look at the chart, this thing kind of ran after being above 10 again last week. So being in a position where we thought we were going to cruise to max profit, it turned against us. Got below 8 at one point, but that's all right. It leveled back out. And our break-even price now, because I guess what we did to manage this, right, we had the 716 expiring, so we had to do something about that. We rolled that over to same strike for 723. So that had a little bit of extrinsic value left on it. This really would be equivalent to taking assignment and selling covered calls. So we just did this because it was easier. And then we also have our 723 8-strike puts, which as long as it hangs above the 8 level, we're going to get 230 back on those. If CLOV, again, this calculates as if it has expired at this price. So if it stays right where it is, we're going to make money despite, once again, a double-digit % decrease in the stock in just a week's time. But again, if this thing shoots back up to 9, we're going to be sitting on an $830 profit, which in the 11 days that we would have been in on this trade with $8,000 of capital invested is a 10.37% return. But more importantly, we would get that 10.37% return in a very short period of time. So it's over a 2,500% annualized return. So we are really, really happy to see that. And despite the fact that this thing dropped to 8.2 on us, that break-even price, as we could see, day by day by day, week by week, it's lower and lower. If it drops below 8, we can maybe allocate a little bit more capital, but hopefully that's not even going to be something we even have to worry about. Would love it if we could at the very least finish above 8 and just keep rolling these 9-strike puts until we get to a decent profit that we could lock in overall. But again, we talk about that because that's one of the losers that we had last week that we had to roll into the following week. But again, even though it's a loser, we are still looking just fine on that one as well. And that brings us to our last, I guess what we'll call loser that I wanted to talk about last week. SOL, we had, super, super small. It was a $200 loss, but it was one of the losses, so might as well talk about that one. What we did on that was we rolled it and we added a little bit more. Shout out to Fortnite is fun for the follow. Love getting that notification. And every time I get that notification, I pause for a second so I could squint over at my laptop and try to read who on earth just followed me. But welcome to the stream. For SOL, though, we initially opened with 10 of these. And as we like to talk about so often, we never want to go with 100% of the capital that we're comfortable with allocating into a position off the bat. And this is exactly the reason why. We got in on SOL last week when it was trading at 10 days ago. So not last week, but the week before, when it was trading at 8.1. We were able to sell 7.5 strike puts for 25 cents a premium, meaning our break-even price would be the 725 that we have outlined right there. But as you can see from right here, and if we pull up the SOL chart, it went lower than 7.25, which was the red line that we had outlined. And unfortunately, it was another one where it was trading above $8 last week, so we thought we were going to potentially cruise to max profit, but you're not going to win 100% of the time. That's the reality of trading. So how do we manage it? What did we do? Let's talk about it. We first rolled these forward. So we rolled the 10 of them forward, lower strike, 1 week further out, and we were able to get 29 cents for these. But the issue is, right, that we closed the first ones for 40. So if we only sold the next one for 29, we'd be taking an 11-cent loss at max profit, right? So if we only rolled 10 of these forward, our overall position, we still would have made money because this is a 15-cent loss, then we would have made 29 cents back on it. But in order to juice up the returns a little bit, because I like where SOL is trading in the scheme of things, if we zoom that chart out a little bit to the 20-day, it's getting to a low point, so I anticipate some sort of a bounce. It typically behaves a little bit erratically where it could drop quickly, but just as quickly as it drops, it could bounce right back for us. So I wanted to increase our position a little bit, and again, we've got less than $2,500 in on this, so we could pretty easily increase this further if need be. But long story short, we got in on this 10 days ago when it was trading at 810. But with our roll and with adding to our position a little bit, rolling down and out to 7.7 puts for July 23rd expiry this upcoming Friday, we were able to get our break even down from 725 to 681, which is roughly just under 50-cent reduction in a week's time, which I thought was a really solid reduction, a 15.93% reduction overall from when we entered in on the trade. So again, we're dropping that break-even price very, very, very quickly, playing as much defense as we can because, again, overall in the market, things are a little bit shaky. So if we do see some serious red in the market, we want to be protected and get that as low as possible. And by rolling this down from 7.5 to 7, we know our situation last week was if it finished above 750, we were going to hit max profit. Now, since we were able to roll down and still get like an overall credit for the move that we made, we're in a position where this is not our break-even price, or excuse me, this is not our max profit price. This down here at 7 is our max profit price. So what we could do is, get rid of this red line, zoom out a little bit on the y-axis, and know that our break-even is now 681. So we could draw that on there for reference as we check on the chart this week. So question in the Twitch chat, are these all covered calls? So what we're looking at right here, these are cash secured puts. Covered calls would come into the equation if so we rolled these because they were in the money for a loss, but our other option would have been to not do anything at all. We would have been to sign shares of SOL, and then we could have sold covered calls on those. But pretty much everything we're talking about tonight is going to be either a cash secured put or covered call in the context of our strategy that we run, which we call the HT wheel strategy, because it's like a traditional option wheel, but we have a few modifications that we make in order to increase profitability and consistency and, in my opinion, safety as well for some of these plays. And maybe skipping ahead a little bit, but this is our year-to-date summary tab, our performance, and we have outperformed the S&P 500 pretty well so far. Dashio, quick question on the break-even price. How is it $6.81? So our initial break-even price was $7.25. We closed these out for a $1.50 loss. So the way we figure out that it's $6.81 is what price would this get to, right, before our total profit started going negative. So if we put in 6.9, we see that these would be worth 10 cents at expiry, the 7-strike puts. We still would make 285 on those compared to the 150 loss from last week. So we still would be in an overall profit position, but it's not until you get down to 681 that that overall profit position goes to break even. And then if you go obviously further down than 681 to 670, that's when we start losing money. But yeah, so 681 is that point though, where the money that we made on the 15 7-strike puts that we've sold for the upcoming week is gonna at least begin to outweigh the loss that we took on the initial 7.5 strike put from last week. So two distinctions to make is one, we changed the strike of the put, and two, we sold 5 more than we had the previous week. So that helped us further play some defense on that one. So let me get this back to the Google Finance. There we go. That is now pulling in the live price, and that is pretty much everything I wanted to talk about with SOL. It sucked that we had some losers that we had to manage, a little bit more than normal, but if you take a look at the overall amount of positions that we have in our portfolio, these are relatively steady, right? We've got ALEC, which is expiring in August. That one's pretty steady. I am considering getting out of this one because it's taking up a little bit of buying power at the moment, and I think tomorrow morning when the market opens, we are going to see some decent buying opportunity because we are pretty red right now, but again, it's 9:30. We are still 12 hours away from the market opening, so much could happen. But in times like this, especially when I guess we could flip over to the SPY chart right here, the S&P 500. When we start seeing sell-offs like this, implied volatility is going to start to rise. Put premiums are going to look really nice. So if we have plays like this where, at least on ALEC, we're already above 50% of our max profit, and we still have to wait another 5 weeks just to get the remaining 50%. Sometimes when you're in a situation like that, it's taken up whatever, like 10,000 of buying power. It might be better to just close that out, take what would have been an $800 profit off the table, and then hold on to that 10,000 bucks. And if we see anything once the market opens tomorrow that looks attractive to us, we could roll that buying power into that. So yeah, I think that is kind of my big plan. I don't really have my eye on too many different things. There are definitely a couple stocks we could talk about really quickly. But that does it for the recap. I think I took a little bit too long, but it was important to hammer home some of those points about CLOV, SOL, BBIG, CRSR, and what we're doing to manage those. And so many times I feel like we get comments that are like, oh, man, we got into this play and it dropped. Like, what do we do? So hopefully everything we outlined here explains exactly what we're going to want to do in a situation like that and why, while it sucks to have something move against you, the strategies that we have in place are designed for us to be able to have some sort of decent contingency plan and be able to recover any of those potential losses when something like that happens to us. So with that said, that is our recap for the week. We lost money. Year to date, we are just barely, we're $18 red in July right now. I think one of my points of pride, I think personally for the year so far, is that we haven't lost money yet for a single month. So definitely going to be keeping an eye on this one as we have what I think we're going to call, 2 weeks left in July to get that back to a green number, so I could have the bragging rights of being able to say that we made money every single month this year. But things are looking okay, right? If one of the best ways, and I think I've done this before on the stream, one of the best ways to evaluate potential profitability and how well positioned we are to make profit in a given week is to throw potential, prices in there, right? We know if SOL finishes above 7, that's going to hit max profit. We know if CLOV finishes above 8, that's going to finish at max profit. Even if CLOV just sits right where it is at 820, these are going to be worth 80. We're going to make money on those. And, we start to see us recoup a little bit. That's enough to turn us back green in July, but that's kind of the line of thought that we're going to follow right there, and evaluating what our positions are looking like going forward. And again, you might say, okay, if you hit max profit on 2 of these and profit on the other, you're making less than $1,000. You're making 0.56%. That's not that's not a lot, right? We're averaging 1.96% a week. However, right now, as you can see, just from the amount of plays that we have in here at the moment compared to what we currently hold on a week-to-week basis, things are a little bit thin. So we're definitely going to be looking to make maybe 2 or 3 different entries at some point tomorrow morning. And the stocks that we're going to be looking to do that on are going to be what we discuss right now. So let's get into what we're looking at for this upcoming week. So one thing that I think is useful is this watch list that I built. We talked a little bit about this on the stream last week, or maybe on Wednesday when we talked during the midweek. This is something we'll be rolling out and giving people who are part of our HT Premium package access to. And the goal for us is to have notes built out on every single one of these tickers, so you know exactly why it's on our watch list, exactly why we have the price target that we have, and exactly our plan for playing the stock when it does reach our price target. But what we can see right here is we have some stocks where, as indicated by column E, they have reached our price target for entry, and we haven't done anything yet. So that means it is time for us to have some action. Those stocks right now are Zillow, Opendoor, ticker OPEN, CLF, which is Cleveland something. It's a steel company that we talk about a lot. And then ATOS. So we've got 4 stocks on here that are at a good entry point based off, what we've seen in the charts, what we have watched on these stocks individually on a week-to-week and month-to-month basis. So 4 things on here that we're comfortable with potentially getting in on this upcoming week. So let me quickly highlight these so I don't forget to talk about any of them. Opendoor, Zillow. And we're going to highlight those yellow. Okay, so taking it from the top, excuse me, a little stuffed up right now, but we're going to talk about ATOS. I'm going to take a sip of water really quickly, and then we're going to start taking a look at some options and charts. All right, so ATOS, first one because alphabetically it is first on the list. But we had an entry point of 5 picked up on there. Full disclosure, the only reason I am not in on this one is because Thursday and Friday I was out of town, busy, and just not at my computer to be able to do anything like this. And I had CLOV, SOL, and a couple others to manage. So I think exclusively trading from my phone, it's not a position where I wanted to be adding to make things more complicated on myself while I was on a trip. But with where it's at right now, I dropped 20% on Friday, trading at 450. Let's see, we have these on here from a play we thought about a couple weeks ago, but they are relevant now, so we're going to remove those drawings. The way we always like to look at these things is short term first, right? This is the last trading month. We can see about a month ago it was trading at 512, but with it bottoming out, this is pretty much the low end of the last 1 month trading range, 449, and then it topped out just under 10 a share. But, we start a little bit smaller, then zoom out to the 180 day to see if we could find some longer term trends. So as you can see, 180 days ago, this thing was trading under $2. It hovered around 50 cents a pop for a while in the back end of 2020. That's a little bit misleading because 50 cents, is that bottom end of that candle. It really hovered around $1. So when we think about plays like this, we always want to be super cognizant of the basis that we have. And when we sell cash secured puts on a week-to-week basis, where do we think we can get our break-even price, and where do we think that break-even price matches up with areas of support and resistance on a chart like this. So the first thing I always like to look at is what is the single worst thing that could possibly happen if it really gets back down to where it was trading at the end of 2020. Are we potentially looking at this thing going back down to $1 a share? And to that, I say no. I think, one of the worst case scenarios for the short term, at least, and I say short term meaning the next 2-3 months maybe, is this red line I drew on here a little earlier, because we could see it if we zoom in a little bit. It bottomed out around here in January. Bounced off this level again, chopped around this level, and dipped for a couple weeks in April. But once it broke back through this level with this big green line, it started making its run up towards 10. So if it does fall down, I think if it really, really crashes, this $2 level is where we are going to see support. So that begs the question, do we think we're going to be able to get in on a play, or I guess a series of plays that we have planned where we can get that break-even price around $2 a share? And I think the answer to that is yeah. So if we look, and again, similar to BBIG, one of the things we really like about this is one, there are options on a weekly basis. And two, there are options at every 50-cent interval, meaning we have a lot of flexibility about different strikes we could pick, different, trade-offs between downside protection and upside reward. But, it's always better to have more options than fewer options. So we love the fact that the 50-cent intervals exist on this one. Two, there is a ton of option buying activity here. We have thousands of the volume is in the thousands rather on several different strikes here. So this is one where, liquidity is not going to be too big of an issue. So with all of that in mind, I think this is a really solid place to be. The way that these options are priced, again, imply that there's going to be an 84% move in either direction in the upcoming week. That would put your theoretical downside at about 380, 370 for the upcoming week. So, using that as kind of a baseline, what play could we get in off the bat where we have a 370 or 380 break-even price? And the answer is going to be these 4-strike puts right here, which are selling for between 20-25 cents a pop as of market close on Friday. So if we pull the calculator up really quickly, we could get a good high-level overview of what this kind of payout looks like. And again, keeping in mind that 1, 2, 3% of max profit is what we're aiming for on a week-to-week basis on plays. 3 is kind of getting up there. But if you get 20, it's between 20 and 25. We'll call it 22 cents of premium on a 4-strike put. That's a 5.5% return on risk in 1 week, which is a huge number. So that is not a terribly bad place to start. One thing, admittedly, that I'm a little bit in the dark on is if they have any potential upcoming news. And if we look in that, not sure if I'm seeing anything. We could click on this really quickly to see if there's any further explanation. There's unusual option activity, a lot of call volume. Doesn't really say anything about potential upcoming events. But, in the near term, I'm not thinking that, I guess one thing we could double check is if we throw it in here and they have some sort of earnings coming up. But there you have it. No, their earnings aren't until August 12th. So at the very least, we have 1, 2, 3 weeks of just pure option selling before we even have to worry about earnings. And I think that's a very good place to start out. So with that said, the 4-strike put is something that I'm going to have on my radar. With the volatility of this, maybe waiting for some sort of a dip, right? We see futures are already minus 0.5% at this point. It's just before 10 p.m. Eastern. I think maybe, although, if you see a return like this on the table, again, RSI we like to talk about is in the blue, which normally doesn't stick around for very long. So we could expect to maybe see some sort of short-term bounce. Due to that RSI reading, I would say maybe don't try to get cute and wait for some sort of a drop. If you can get anything between 20-25 cents at open, assuming, right, that it's opening around $4.50 a share. If the market opens on Monday and this thing's at $4, that's going to change our analysis a little bit. But assuming it's hovering around that $4.50 level at open tomorrow morning, I really like the 4-strike put. I think that's going to be a really good entry opportunity and a great place to start out, at least over the next few weeks, basis-wise with this. And again, since we did deduce that short-term or maybe longer-term support could be at that $2 level if things really start crashing, super, super, super important to just start off with about 50% of what you're comfortable with. And then to kind of close the loop on this thought, right, we have a position where we're getting about 5.96% return on risk if we sell it fully cash secured. But if we're able to get 20 cents, if we sell 10 of these, right, we're going to get $200 of profit on 26.55 of buying power requirement, meaning it's now a 7.5% return on capital. So, a 7.5% return in 1 week is phenomenal. And if you're only using 50% of what you were comfortable with, it's the equivalent of having a 3% return on what you're 100% comfortable with. So that's still a phenomenal return. Got a question in the Twitch chat from Fortnite's Fawn. How do you find these stocks with higher premiums? Great question. In the first place we like to start is right here on the scan tab. We've got this custom scan that we built out right here with high ROR puts. And this has a bunch of different filters and metrics explaining what exactly we are looking for just across the market for different option chains that's going to return the highest premium puts. So if we do all symbols and we run this scan, we're going to see for the upcoming week tradable options. And tradable meaning, it's not just some weird bid-ask spread that's giving it a huge price, and there's actual volume at those levels. And then this one caveat we have right here is to isolate the ones that don't have earnings. So we say does not have earnings in the next 10 days. And there you have it. If we sort by ROR, return on risk, that's the single best measure of profitability for options and the amount of premium that an individual option carries. And you've got the usual suspects up here. You've got AMC, SPCE, ATOS, and that's where we find that, right? It's coming up at the top of our scan pretty much. So that answers that. And if you want to learn more about this particular scan that we have put together and how to use it, we have a video up on our YouTube channel about how we built this specific scanner and how you can use it to isolate high probability puts. And we're looking to finish up a part 2 to that, because I think we finished off that video saying, here's the list, this is how you get this list. But we didn't get too far into actually evaluating, how you identify quality plays from a list like this. So that is something that's on our list of videos that we are anticipating making at some point in the future, but I feel like that list gets longer and longer because they take a little bit of time to make. I'm hopefully going to be able to finish up a video this week about the risk-free play we had on UPSD, because that was an interesting one, but I think this would be a good video for me to get back in and make once that one's done. And follow-up question there in the chat, how about for calls? And typically when you see super high premium on puts like this, you're going to find equally high premium on the put side. So what we like to do is just take a look at the tickers that we see right here, and then you could you'll see AMC super high premium on the put. You type in AMC, you'll find those puts over here with these huge returns, but you'll see there's similar premium on the call side. So typically it's going to be about 1-to-1. There might be some slight call or put skews, meaning that at similar strikes, calls offer more premium than puts or vice versa. But in general, if you're looking for just covered calls and you go to the scan tab, just typing in the tickers that you see will bring up those calls as well, and the premium is going to be pretty similar on both sides between calls and puts. So we were talking about ATOS, kind of closed the loop on that. That showed up in our scan right here. That 4-strike put is something I really like, and I think a 380 break-even price is a good one to have. And I think one other small point to make about ATOS is we think about not just this week, but weeks going forward, what can we expect on a week-to-week basis. We've got some really decent premiums for even just at or out of the money, right? You can go $3 out of the money and still get 10 to 15 cents of premium per week, and that's something where that's incredibly valuable on a week-to-week basis. If we do have the event where we need to take assignment on these shares, we could set ourselves up where we take assignment with our 380 basis and say, hey, we have a 380 basis, let's leave ourselves some decent upside here. And you could sell at a position where you'd almost make a 100% return in a week or two and still be continually knocking a few cents off that break-even price. So I really like the way this one sets up. I think with the volatility that we've seen right here, we're going to see some decently inflated option premiums in the near term, meaning the next 2 or 3 weeks. That should be plenty to get our break-even price. I would guess in the next 3 weeks, if we start this play out and get assigned, that I would say by August, we have our break-even price below $3 a share with the way premiums are looking right now. So, and I think that would be a good place to be, right? We talked about, just for safety purposes, the long-term support around 2, but shorter term, it looks like 4 might be a decent level of support. So that's another reason why I think those 4-strike puts off the bat for the upcoming week are going to be a great way to hop in on this one. So that's ATOS. Another one, let's see. We can go back to my watch list in a second. There was one question we had in our Discord server that I wanted to address about VBIV, and we had that question from Will House. I don't know if you're on the stream right now, but you might be watching the replay when it comes up, but we're definitely going to address that one since it was asked. VBIV, it's a vaccine company, and we had a question about how they should play it. So it's a pharma company, meaning off the bat you're going to see these huge swings, and typically with our strategy we like to stay away from those because the volatility can sometimes outpace the speed at which we can decrease our cost basis. Like we know if we take a look at our weekly tracker, looking at Corsair, for example, we could continue to lower our break-even price week after week after week, even though Corsair had a really steady sell-off against us. We've still been able to successfully lower that break-even price on a week-to-week and month-to-month basis. But healthcare, you could find yourself in a situation where, I don't know if it applies to this stock, but yeah, if you get in at 5 and it falls off the face of the earth down to 233, I guess this one's a little more gradual. A better example that came up this week was FGEN, where it dropped from 27 to 14. I know some people got in a little bit of hot water with that one, but healthcare is a lot more susceptible to these enormous candles, and those don't really bode well for our strategy. We could handle the chop upwards and downwards and handle some decently sized losses, but the big one-day red candles are the ones where we really find ourselves getting into some trouble, and healthcare is an area where you're going to see that. But with VBIV, oops, I don't know where I'm typing. There we go. VBIV, yeah, I mean, you potentially could find yourself in a situation where it gets back down to this base-ish level of, it bottomed out at 47 cents, but again, this is back in 2019, so I can go back to the 1 year for a little bit better short-term idea. $2.50, $2 a share seems like potentially the shorter-term downside on this one. I don't know if they have any information coming up. Looks like they're involved with hepatitis vaccines. Looks like they have brain cancer immunotherapy. So when you see things like that in the news cycle, knowing that they have multiple drugs in the pipeline, multiple different things potentially on the horizon, that's encouraging, because if you're playing a biotech stock where they have one big drug that they're relying on, those are the ones where if they have a bad FDA approval or something like that, they just completely fall off the face of the earth and you're looking at a pretty big loss. But this one looks a little bit steadier, so we'll go through the process. I think the question that was asked was whether or not you could buy shares and sell 3-strike calls for August, or if you should sell the 3-strike puts. So I think it's probably going to be pretty similar. What we know about the 3-strike calls is you'll get 25-30 cents of premium, meaning your break-even price is going to be about 263 to 268 if you do the calls. And maybe an easier way for me to go through this process would quickly be to pull a notepad up on the screen so I could write down what I'm saying. So if you go covered calls, CCs is what we're going to call these things right here, and you do 3-strike calls, you get shares at 293, assuming last Friday's closing price. 3-strike calls at, we'll call it 27 cents, the midpoint right there. So we know our break-even price on that is going to be 2.93 minus 27 cents, which, oh boy, math time, 266, I want to say. I need to double check my math on that so I don't make a blatant elementary school math error live on the stream. 266, I nailed it, still got it. So if you do covered calls, you have a break even of 266. Your shares could get called away for $3 a share, so your upside on those, right, if you have 266 basis and you can get them called away for $3 a share, is 3 minus 266, and I'm spelling upside incorrectly, but that is going to be upside of 34 cents, which divided by your break-even price, we can even give this an ROR percentage. So let's pull that calculator back up. I guess I jumped the gun a little bit by closing out the window on that thing, but if you get a 34-cent return on a break-even of 266, that's going to be a 12.78% return on risk. So not a bad value prop right there. But again, these are all the way out to August, so you got to wait a little bit of time. But that's the break-even price if you want covered calls. The question is, what if we go cash secured puts? What you would do is you would sell the same thing, the same strike that is. So you'd sell 3-strike puts. Those are trading between 30 and 60. This is a little bit tougher to deduce because this is a much bigger spread, obviously, than the 5-cent wide spread. We can maybe take a look here at the option time and sales from Friday, or maybe we can't do that. Yeah, it looks like that info went away at the end of the day on Friday. But I mean, we can, I guess, call it the midpoint. Let's see if we can pull up last. There we go. The last that they traded at was 40, so we'll call those 40 cents of premium. Meaning your break-even price is gonna be $2.60, and which is, again, this is gonna be better than covered calls. So we have one win right here for the cash secured puts, and your upside on those, right, is gonna be the amount of premium you sold, 40 cents. 40. So your ROR, if I can pull the calculator back up on screen again, I don't know why I ever even get rid of it, but 0.4 divided by your basis at 2.6 is going to be a 15.38% return on risk. So again, that outweighs the covered calls as well. So this is one of those examples where we see a little bit of a put skew, right? Because you get a little bit more value out of a 3-strike put than you do out of a 3-strike call. So if you could get a 40-cent fill on a 3-strike put, that's going to be a little bit better of a value for you. They get to be the exact same, I think, when you get down to 34 cents. So if you could get a fill better than 34 cents on a 3-strike put, it's going to be a better play than buying shares and selling 3-strike covered calls. So there you go. That is the answer to that question. That is the spiel on VBIV. And with that said, now that we got that answered, we're going to get back to our watch list and go back through the last few that we were looking at for this upcoming week. So we talked about ATOS. We're going to say looking to enter 4-strike puts. CLF is a really interesting one to talk about because not only is this one in a really nice place for entry, they also have a really nice margin requirement privilege, whatever you want to call it. I feel like we probably need to come up with a better term for that. But it requires a lot less collateral than if you sold it fully cash secured, so that's going to make your return on capital numbers look insane. But with that said, let's take a look at CLF. So here is the chart that we had on this one. This is the 1-year chart, and you know I've mentioned that this is a little bit scary because a year ago it was trading at 5.16. Appreciate those comments in the YouTube chat, Rakesh. Appreciate you tuning in and commenting. But moving forward, CLF was trading at 5 a year ago, so this is one that we've talked about a little bit. It's a steel company, and when we talk about inflation in the overall market, we know that steel, commodities, things like that typically are decent hedges against inflation, and we've kind of see that play out a little bit with steel. And the other thing with this, the impacts that COVID has had on the overall economy, there are a lot of supply chain issues, meaning demand is through the roof, supply can't meet it, so prices on commodities are also skyrocketing. Steel has been a huge benefactor of that, and I think the CEO of this company mentioned that he didn't think demand was going to change anytime soon. Maybe more importantly on this one is the fact that they've got earnings this upcoming week. We can see that by clicking the little blue circle right here. Earnings on July 22nd, 2021 before market central time. So that's going to be, well, I think Thursday? Yeah, Thursday morning is when options on this one are going to come out. We had 21 booked as a good entry price on that. Let's zoom in a little bit to the last month. Huge drop off last Friday from what looked like it opened at 21.75, down below 20 at market close on Friday. But if we back up a little bit further, we're in and out. We can see that support looks to be right in this 20-ish level. We see it bounce off there back in June 18th. We see another bounce back on July 8th, and it kind of topped out before pulling back in the end of May, right? So when areas of resistance are broken through, they turn into support. That's what we saw. It resisted the 20 level, broke through the 20 level, shot way up, and then it became support. So, we like the idea of getting into a steel play. The question is, what strike put are we going to be looking at to get in on something like this? And the answer to me is, once again, going through this process of looking at what's the potential downside here coming up, what what kind of ROR can we get on something? What kind of ROC can we get on something? I think the downside here looks to be roughly in this 18-ish area. There is some decent support potentially around 19, but we want to be safe as possible. So I think whatever we could set ourselves up with a break-even price of around 18 a share is going to be a good place to be. We look historically over the last 180 days. Let me get back to this chart. At some of the earnings, which are indicated by these red dots that we see right here. They had a pretty big drop back in February where they went from 16 down to 13, so roughly a $2.53 drop on that one. They had a tiny drop back in April. So from the two that we can see in the last 180 days, we see a roughly $3 drop, and then we see pretty much no action. So that's about the move that we could try to expect. The implied move that we see right here is a $1.94, which puts us right on the 18 number that we were talking about. So with that in mind, what are we going to want to sell that'll give us an 18 break-even price? And the answer is going to be these 18.5 strike puts that we have expiring on July 23rd, this upcoming Friday. These are 18.5 strike. They have 50 cents of premium, and we know that an 18.5 strike with 50 cents of premium is going to give us a break-even price at 18 bucks right there, which on the 180-day chart is right about there. That's a little bit lower, but bear with me. And when we draw that line, we can learn even a little bit more about areas of potential support and resistance, because while we did only look at this kind of shorter period of time right here, and we saw a little bit of support in the 20s, as this line extends back out to the left, we could see this 18 level was pretty solid resistance back in February. It acted as resistance again in March a couple times, and then it finally broke through and became a support level back at the end of May. So that's further evidence that this 18 price level is one that's probably not going to be given up too easily. So even if we do have a bad result after earnings, the idea is going to be that it'll at least hover around this 18 position, so we could potentially either lock in a small profit or have a pretty advantageous basis if we were going to take assignment of the shares and then sell covered calls moving forward. So I like the 18.5, and getting into the point that I alluded to a little bit earlier, the buying power requirement on these is very, very low. So we see the standard calculation of return on risk, right? We can get a 50% of premium on an 18.5 strike. That's going to be a 2.7% return. That's what we see right there. That Thinkorswim calculates a 2.78% return if you sell these fully cash secured, which is, again, right in the wheelhouse of that 1 to 3% weekly return that we like to look at. Nothing wrong with the value proposition on that whatsoever if you wanted to do those fully cash secured. But things get interesting if we were going to sell 10 of these, right? We know that it would, excuse me, I need to click on these. If we wanted to sell 10 of these at 18.5, we know that it would take $18.50 of buying power per. So this would be an $18,500 position. And if we look at this, it doesn't require $18,000 of buying power. This only requires $2,500 of buying power. This is an insane amount of leverage that the broker offers you. So you would now be getting a $490 max profit on $2,500 of collateral, meaning that it's a 19.6% return in 1 week. And that is huge, 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 huge for a stock like this. So with the amount of leverage this offers, this is definitely something I'm going to be looking to get into, because we could lock up a small amount of buying power and still generate a really nice return number. So I'm going to look to sell, I think, about 10 of these in the morning tomorrow. And keeping in mind, if you do go the leverage route, while you may have 10 of these locked up and it may only lock up $2,500 of buying power, you really need to have the capability to take on an $18,000 position, right? Because if you're using leverage like this and it starts running away from you, we want to be able to take assignment and be able to handle a position size of $18,000. The fact that leverage is offered is just a bonus that lets us be a little bit more capital efficient and push some money into other plays while we're waiting on this one. It's not to say that, just because I can afford a $10,000 play means that I should use $10,000 on a leverage position. No, it means that, you could use $2,500 on that position and then have $7,500 freed up for something else, while being comfortable that, if you did need to take assignment, you could take on that full amount. Just because we can afford to sell something with leverage doesn't mean that we should sell that entire amount. We want to always be cognizant of the max loss on a leveraged play, because that is the quickest way to run into trouble if we see a bigger downturn in the market. And that's a very easy way to take what is a relatively safe strategy and make it something dangerous and put yourself at risk of blowing up your account. But with that said, I'm going to start with a position like this. I think about 10 of these. Look for that 20% return on capital number and try to pull about $500 on this one as we head into earnings. If things go against us, I'll have some cash on the sidelines that we could, potentially roll the puts down. We could take assignment and sell conservative covered calls and get into a covered strangle. But a lot of options available to us. Just make sure you afford yourself that flexibility on the front end of the play so that if things go against us on the back end of the play, you still have a little bit of recourse. Prinzmeister question in the chat saying, if we're already in the 21 put for this upcoming week, what would you suggest doing? Would you suggest an additional 18.5 hedge or just hold it out? So I think I would hold on to what you've got, right? Because let's think about potential outcomes if you're in on a 21 strike put. Not sure entirely what premium you were able to get, but I imagine your break-even price is somewhere in the neighborhood between 20 and 20.5. So we'll hypothetically mark it off with that line right there. So one of two things are going to happen, right? Earnings are pretty binary. If we have that third option of them presenting earnings and the stock doesn't really move, in which case you'll be able to roll your puts for a credit and get that break-even price further down. But in general, there's really one or two things that's going to happen during earnings. They're going to kill earnings. The stock's going to shoot back up, in which case, guess what? You're going to make money. You're going to be back above your break-even price. You're going to hit max profit. And you're going to have nothing to worry about. But two, and as always, this is the one that we want to be cognizant of. What happens if it starts tanking further? If you sell 18.5 strike puts right now and it tanks further, you now have another position that is going to start losing you money. What I would suggest to do, if you do have the capacity to enter into some more cash secured puts on this one, is wait until right after earnings. If they tank right after earnings, it might end up somewhere right around here. And if it is in that neighborhood, one, you're going to be happy that you weren't already in on 18.5 strike puts. But two, IV is usually a little bit elevated for the 10 to 15 minutes at market open right after earnings. But then you'll be able to open an even lower strike, take advantage of that IV, and be in a little bit better position overall. While that 21 strike is going to be hurting a little bit, you're going to be doing a lot better than if you opened an 18 before earnings and it tanked on top of that. So I'd say hang steady with the 21. If it goes back up, awesome, great job. Take that money, run to the next play. If it goes back down, that's when you start thinking about allocating a little bit more money into that position via another cash secured put at a lower strike. And then start, running into the HT wheel, whether you want to keep rolling your puts or jump into a covered strangle from there. That is when that option would present itself. But I think off the bat, if you're already in this play, it started to lose some money on you, don't put more money on the table yet. So that would be my advice on that one. But, closing the loop on the little conversation we had on CLF, that's one where I'm going to be looking at 18.5 strike puts that are going to be expiring on 7/23, using a little bit of that leverage. And I have these highlighted as kind of a note to self that I want to do something with them for the upcoming week. Open Door, this is one that I think is just awesome value right now. But, you run into the issue where it's one of those stocks that does not have weekly options. So the next expiry is going to be August 20th, and we run into the other issue with those monthly options at a time like this, which is that August 20th is like 1, 2, 3, 4, 5 weeks from now. So that's 5 weeks of potential weekly plays that you could be making. So when we run into the position where we run into a long month like July, and there's that little bit of an extra week where, typically on a week-to-week basis, typically on a month-to-month basis between monthly option expiries, it'll be 4 weeks. When we run into a long month like July and get to a situation where it's 5 weeks between them, I really think it's better to wait until the 3 or 4 week window to start selling what we would want to sell on this. So this is one I have flagged as an entry because I think the entry is awesome. This is a great company that is moving to kind of digitize the real estate market. And that's an area where I think it's going to be headed. So I love the idea of the company in the long term. A well-established company, not some random company that you're going to find on StockTwits or, buried in Twitter somewhere. But, they've got advertisements on TV, legitimate company, really nice nice operations, and I like the idea that they have moving forward. But here's the chart, right? And I initially put this on my watch list when it was up in the 30s up here, but long term base again is probably going to be right around this 10, 11, $12 area. So that's something we want to keep in mind. But the reason I have this listed is because if you look at August, we know that 10, 11, $12 area is a good place to be. I thought this was a great company at, mid 20s. I think it's a steal right now at the 14, but just in case it does continue that pullback, what's our best option? I initially had my eye here on the 12.5 strike puts in August. These are ones where it would take, $12,000 roughly if you wanted to sell 10 of those. But another one that has really nice margin buying power requirements, right? It would only require $3,800, and I could pull this calculator up again. 38. Come on. It would, for $500 in profit, it would only require $3,800 of collateral, and that would be a 13.1% return over the next 5 weeks. And any double-digit percent return over the course of a month is a really, really nice value. So I love the 13% return potential on that one, and the fact that your max profit point is going to be at $12.50, a price that this thing hasn't seen if we extend this drawing to the left, a price that we haven't seen on this one since last September. And with the amount of premium that you're still going to be able to get on this, 50 cents a premium roughly, that break-even price is going to fall right at $12 a share. Underneath it, that's a little bit higher than 12, but you get the idea. You get a little bit extra cushion, and that's when we start to line up with these longer-term areas of support that we've identified. So I might wait a week or two on this one, but as it stands right now, I think the value on this, being able to pull 13% in the next 5 weeks, is really, really, really nice. And let me double check really quickly, using that calculator we have for annualization. If we opened the trade on Monday, this is how this is kind of the way to use this thing, right? We open the trade Monday. We know this thing expires August 20th, and we get 13% return on capital. Yeah, that's a 303% annualized return. That is a monster number. So that is not one that I would, now that I know it's 300-something percent annualized, this is where I start to think I might start with the smaller play. Might do 10 of these, throw about 3, 4, 5,000 of collateral at it come Monday morning. But I'm a little bit split. I think in order of priority, CLF is definitely one that I'm going to want to do first. Then maybe ATOS, because again, those are the ones that we could do on a week-to-week basis, a little bit more flexibility in those. And then if I've got some buying power left over, this is one where it's always nice to have some August expiries just hanging out in the background that are much safer. So you'll have those days where the market takes a turn for the worst and your weekly plays don't look too good. It's always nice where you can have a little bit of peace of mind where, if the market drops, or even if this stock itself drops 10%, you could say, okay, well, I'm still, 10% above my max profit points. So there's nothing to worry about. Having these August plays kind of marinating in the background makes for some much lower stress trading. So, I said I like to wait till 3 or 4 weeks out. That 303% annualized return number is super nice. One other thing to point out is if we look at, the historical price of this option, and because we get to a situation where if Open Door bounces and we see a spike in the price, we don't necessarily have to wait until expiry, right? We could be in a position where maybe 1 or 2 weeks from now we have over 50% of max profit, and this is the chart for Open Door. And if we want to do this side by side, we can do that by going up here really quickly, typing in OPEN, and then making sure that this is on. Well, we'll do 180 day and make sure this is on 180 day as well. So as you can see right here, these got down to about 15 cents back in just a couple weeks ago, back in July, at the beginning of July, right? It's still July. But that's when it was trading at about, 16 a share, 17 a share. So if there is a little bit of a bounce back up to these levels over the next couple weeks, we could be in a situation where, hey, we sold these for 50 cents. It's back down to 15 cents. We've already hit basically 60, 70% of our max profit in 2 weeks, which is phenomenal. We don't even have to worry about waiting the entire time. And then if we get in a position where it does drop a little further on us, we say, I'm not terribly worried about that, because if I could type open back up here, we're not terribly worried because we have a break-even price at 12 bucks, and when we look at the chart, that's plenty of cushion. So I think in rambling to myself here tonight, I've kind of convinced myself to maybe change my approach to this one at least, and say that we're going to try to take a look at those 15 or the 12.5 strike puts for 820. Now, what I will say as far as getting it on something that expires in 5 weeks, this is where we can be a little bit more patient in getting a fill, right? You can see it's trading between 45 cents and 50 cents. That that 5 cents is a decent difference, right? I mean, 5 cents off of 50 is like 10% of the premium you'd be collecting just on the stock or on that option itself. So your fill price here is pretty important. And since we're 4 or 5 weeks out from expiry, this is where we could be a little patient, where we could put an order up for, 10 of these for 50 cents and just let it sit. And if it fills, fantastic. We get the 50-cent fill that we were looking for. And if not, we could try again tomorrow or the next day. And then maybe if we really need to, we could drop down to 45 if we're dying for a fill. But I think leaving the limit order open on this one is going to be pretty advantageous to us. So that's going to be the plan. I'm making a note to self here. Limit order at 50 cents. And that brings us to the last one on here, which is in kind of a similar area as Opendoor, being one of those housing real estate-ish companies that is making a digital transformation. And people so often go on Zillow, and I think people are bypassing brokers entirely now to use Zillow for posting their house for sale. I'm sure that was really well worded by me. But yeah, if we take a look at the chart, this is one we've had an eye on because let's get back to the one panel here. It ran up to 208 back in February, so you absolutely know the upside is there. We identified this 105 level as an area of support, and we did start to see that a little bit since it's chopping around the 105 level, and even further below that, this 100 level. If we zoomed out a little bit, you would see there is a secondary area of support. But this 105 level should be pretty strong. Taking a look at RSI in the short term, I think this is a really good entry point because it's down in the blue right there. Last time this thing was down in the blue was back in January when it bounced from 127 up to 200. You could look at another instance of it being in the blue when it bounced pretty hard here. And while sometimes it can be, quote unquote, in the blue and move further down, it really only did so for a couple days before seeing it bounce back up to the a more natural price level. And same deal right here. It's in the blue, and we can see that lines up perfectly with the bounce. And just long story short, this is why we love RSI as an indicator for entry point. So we've got this lined up with our target. Our target price was 110. We've got this thing sitting at 105. That lines up with support. RSI indicates it's overbought. I think this is a good entry. Now, what scares me a little bit is back up to the 1 year, you start to see it trails down a little bit further. So I think, once again, it's one of those things where being conservative is going to be something that pays off here, because if we go even further back than the 1 year to the 3 year, it was hanging out in the 30 to 50 range for a decent amount of time, and then was right around $60 before it really started taking off. So if things get really bad, I could absolutely see this thing coming back down to 60. But on a week-to-week basis, I think, at least for our purposes, starting off and having a break-even price around that secondary level of support that we've identified around 100 is where we're going to like to be. So if we go to the trade tab, we see that if we sell 101 strike puts, that's pretty much exactly what we're going to be able to do with those. The 101 strike minus about $1.30 of premium is going to give you a 99.70 break-even price on that. So I mean, just from an ROR perspective, that's 1.3. That throws your max profit right about, I think, probably would be better seen on the 5-day chart. Max profit is 101 right here, which is a decent drop for a week, even though we're coming off of a week where it went from 117 to 104. So I think 104 to 101 is not out of the question. But it's got to bounce at some point. I like what we're seeing on the chart, as we just illustrated with RSI and levels of support. So this is definitely one I've got my eye on as well, with that 101 strike put. And as we know, if we wanted to sell one of these at 101, it would take about $10,000. But TD Ameritrade gives us some really nice margin requirements on those, which is why this has been one that is particularly of interest to me. And again, just keeping in mind that even though if you want to do one of these and lock up $1,700, just knowing that overall it's a $10,000 position. So if you use leverage, just be sure that your account can handle taking assignment of that full position. When you start getting margin called because you have leverage over and have positions that represent balances over what your account can handle, that is when you start getting into some trouble and have to close positions for losses and can't do the things that we do to manage our positions and start getting into some hot water. But to continue the discussion we had on, return on capital with the margin on this one, you'd get 123 bucks of profit off 1768 of collateral, meaning a 7% return in 1 week. That's an awesome number. That's pretty much matching up damn near with what we've got on CLF, ATOS. I mean, we've got all of these plays, I think 3 that we're going to be looking to get into tomorrow morning that have really, really nice weekly returns. So looking forward to that. But, with what we have on our watch list, and we're going to keep adding to this week after week, we're going to add more price targets. We're going to add some detailed notes in here. And I think this watch list is going to be a really, really nice resource for you guys. But that is what we have identified based off the price targets we've set. We have some that are getting close, right? We have SoFi set up at a 15 price target, sitting back and patiently waiting on that one. STM is one we talked about last Sunday when it was trading at about 30, and that one's already halfway to our price target. Penn Gaming is getting closer there. Palantir is getting closer to our price target. LOTZ is dead on the price target right now, so if it drops a little further, that might be an interesting one to look at. DraftKings, Delta, I mean, things are getting very, very close to our price targets, so we've got a lot of potential plays coming up. This will be a great resource to keep your eye on, and a great one for us as well to, circle back and continue to update price targets, update notes that we have in there, and hopefully make it as helpful as it can be as possible to you guys. But with that said, I think that, pretty much covers everything, one, that we're holding on to for this upcoming week. And if this white screen disappears and starts showing the spreadsheet, okay. Yeah, so one, I think this covers everything that we've seen on the, this covers everything that we are holding heading into the upcoming week, what we have, why we still have it, contingency plans for things that we have held on to, and where we see different things finishing during the week for what we currently have. And 2, covered what we have as far as stocks that we want to potentially start playing this upcoming week. And we've got, Prince Meister giving me a little bit of crap for having Hyliion on the watch list. But I will say, if I don't have a price target on here, it means it's not a company that I'm really looking to enter. Like you'll see, I have AMC on here, right? But it's one of those things where, it's nice to have on the watch list because sometimes there can be a big move in the stock that'll create an opportunity for us. But as of right now, I don't have a dead set price target, so that's something I would add in the notes. But Hyliion kind of fits the bill there as well, being something that sometimes there's some super big moves that create premium and create opportunity for us. But as of right now, don't really see anything. But with that said, we're pretty much at the hour and a half mark. Hopefully, we have been able to give you guys some good ideas as we head into the trading week. I know it's kind of helped me out a little bit too, running through that watch list and throwing some different potential entry plays on here as we evaluated the stocks that have dropped below our entry price targets. And hopefully we could do a little bit better than we did last week, and more importantly, get myself back to a position where I am green overall on the month of July. But again, you can't beat yourself up too badly because so far year to date, our strategy has performed incredibly well against the S&P 500. I don't see any reason why that would change. I think the biggest thing that we could screw ourselves over by doing at this point is, like we mentioned earlier, getting over leveraged on positions so that if the S&P 500 does experience a decent drop in the upcoming weeks, that our drop would outpace that. Yeah, when we're selling things fully cash secured, right, we get a more favorable basis than if we had just purchased the stock straight up. So theoretically, the strategy that we're running is going to outperform by nature when the market pulls back. So, I mean, we always welcome pullbacks because, one, technically we should outperform, and 2, it gives us some really nice entries into different stocks that we have on our watch list. But yeah, futures hanging right around that 4,300 level, minus 0.40-ish% as we head into tonight. So interesting. I will be interested to see where that opens up come morning. But as always, we're going to be live and chatting in our Discord. So if anything crazy does happen, we see any other interesting entry opportunities, that'll be the first place we talk about it. But with that said, that is where we are going to cut off this week's stream. Once again, thank you guys so much to those of you who have been tuning in week after week. For those of you who are new following us, thank you so much for joining, and hopefully you'll be with us for future streams and hanging along with us in the Discord this week. And thank you for your time tuning in every week. I know we all appreciate having you in the chat. So I'm once again going to sign this off with the super corny intro to the videos that I have, which hopefully I can actually finish a video this week, so we'll get to hear it one more time. But thank you for watching us this week, and this has been the Hourglass Trader, where as time passes, we make money. Let's have a good week, everyone, both in the market and out of the market. So we will thank you for tuning in this week. We'll see you in the Discord this week, and if we don't see you in the Discord this week, hopefully we'll see you next week. But that's all we got. So thank you so much, you guys.